Get Justin in here as well. All right. Good morning, everyone. Thanks for joining our webinar today. We will kick off in another minute or so as we give people a chance to join. See. And yes, for those in that question, this recording will be available after the webinar. We'll send an email so you can view the recording. And we will also save a version of it in our knowledge base, which you can access through the Income Lab application as well. Oh, let me. See if we can get Justin set up in here. Okay. Okay. Good morning, Justin. Looks like you're connecting. Morning, Justin. Can you hear us?
Yeah.
Okay. Okay. Awesome. Well, thanks for joining, everyone. We are looking forward to kicking off our user webinar for you this morning. Before I turn it over to Justin and Derek, wanted to just go over a few things here. You'll see in our Zoom webinar, we do have a Q&A section. So we'll have the first half of the webinar be the presentation, and then we'll open it up for the Q&A. And since this is a user webinar, this is a chance for our users to not only hear from our experts, but really give you a chance to ask those questions you've had around the software and different things we can help you at in this space. At the end of the webinar, you will have a survey where you can give us suggestions, or if you'd like a team member to reach out, you can also note that in that survey as well. And then we can set up onboardings or more one-on-one sessions as well. We do have another webinar coming up December 9th, which will be a CFP-CE webinar. I will drop that registration link in the chat for our users who would like to join that webinar as well. And then you'll get an invitation via email for that webinar on the 19th. Okay, that's all I had, guys. Justin, I see you're ready, so I will turn it over to you.
Great. Thanks, everybody. Thanks for coming. Hope the end of the year is treating you well. Yeah, today's webinar is really hopefully a very practical webinar based around kind of using some personas and typical situations that you might run into in retirement income planning, and highlighting kind of how to handle those situations in your practice. Hopefully the actual examples will provide some really useful case studies and information for you in your planning, or bring up questions for situations that you've dealt with that we can address here. So hoping this will be really practical for people. The way that I designed kind of the cases that we'll go through is, first we'll spend most of the time on kind of an at-retirement persona, and really looking at modeling a range of retirement factors. And then toward the end, we'll kind of switch to looking at a pre-retirement situation, so adding some savings and pre-retirement situations, and then a quick look at some tax planning situations. So the at-retirement persona is fairly complex, but really not. We're talking about 8 little factors here. A roughly $2 million portfolio. It's a joint household, both age 61, almost 62, so just before they could file for Social Security. They still have a mortgage, but that'll be paid off soon, and they have some rental income, and they're looking to spend about $10,000 a month. We'll add in a few other little things that are kind of both typical and also places where we can talk about some of the power of Income Lab to really capture some of the ways that people's lives can look. So for example, we'll throw in a downsizing of their house, maybe moving to a condo in 10 years. We'll look at how to evaluate different Social Security claiming possibilities. We'll look at a pension and a specific expense plan. In this case, I used self-insuring for long-term care, but that could be a stand-in for any kind of specific spending goal. So with that, I'm going to switch over to our software, and we'll see, the balance here. In this baseline, what I've done is what we find people will often want to do. It's definitely not the end of the line, and you'll see why. But all I've done here is put in this household's portfolio, and you can see that their spending possibilities with this portfolio are nowhere near what they actually want with this, which is $10,000 a month. I'll use this, we'll go over the assets first of all, but then I'll talk about why, although I understand why people sometimes want to say, well, put everything else aside, just look at the portfolio, and let's see what we can spend. And I want to talk a little bit about why that's not a good idea. But just to kind of highlight what we have in the portfolio here, we've got a joint brokerage account of $800,000. I believe I put the basis is at 600. Both of the spouses have a workplace plan of 500,000. I also threw in a non-qualified deferred comp plan. So for those of you who haven't seen this, there are a couple of account types in Income Lab where you can specify how that account is being distributed. Okay, so typically with a non-qualified deferred comp, you do have to say, okay, this is how I'm going to take this amount of my deferred comp. If you have, a deferred comp plan with many different slices and sets, you're going to have to enter each one separately. It's basically, for each chunk, what is the distribution plan for that? Those same capabilities are available for inherited accounts. So the inherited retirement account, in this case, it's an IRA. That's fairly typical, of course. There's also an inherited Roth option, but again, you have these distribution settings. In this case, we've just set it to be a lump sum. Let's imagine this is sort of the end of the 10-year period, and they're just, hey, we'll take it all at that point. You could certainly do an installment plan as well, and it will automatically figure out how much needs to be taken out in each year, in each month for that inherited account. So this is this is all that's in this plan, other than just a set of baseline expenses of $10,000 a month, and we saw that that's not going to be enough for this household. And a few things when people are trying to look at these and say, well, what's the withdrawal rate is often what people are after. You'll see here, okay, well, it looks like it's somewhat under 4%, right? Now, there's a few things that are really important here. In Income Lab, we're all about giving really customized advice to clients. So there is no right answer to how much you can withdraw from a portfolio. In particular, it's going to depend a lot on the length of the plan, on the fees, on the allocation, and so on. And any change to those is going to change how much you're able to take from the portfolio. But we can look here and ask, for example, well, how long are we planning for? These folks are in their early 60s. If we go to Power Planning, I can see, okay, we're already planning for a 34-year retirement. And that's that's longer than maybe you might be used to seeing for those cases where you're looking at, the 4% rule, for example. But one crucial thing, and this is actually our default, I switched it on here. I'm planning for straight line, adjusted with inflation spending. That's not typically how people actually behave. So I'm going to change this to include the retirement smile. By just going to retirement and changing it to age-based. So now my spending will change depending on how old I am in the retirement smile. Okay, and you can see here, if I go to my income scenarios, I can compare. All right, I got an extra $1,000 a month in spending just by planning for my spending behavior to change over time as I age, in this very typical kind of ski slope shape. So again, this is the default in Income Lab, and you can see that the power of it, especially for younger people, is that you're able to spend more when you're younger and typically need it, by not planning to spend so much when you're older, when you probably won't spend that much anyway. So this is all based on, probably the most well-known research is David Blanchett's, but there's other research on kind of the life cycle of spending, the go-go, slow-go, and no-go years. There's a lot of different ways of talking about this, but you can see how powerful that is. And already now we can see, okay, the withdrawal rate, quote unquote, is up to almost 4%, or actually probably is 4%. But again, this is not enough for this household, because if you remember, we actually had other things. For example, they both have Social Security. So let's add Social Security. We'll go to cash flows, mark them both as eligible. Let me take a look at my notes and make sure that okay. All right, so we're going to assume $2,500 primary insurance amount for John and $3,500 for Mary. The primary insurance amount is what you would find on somebody's Social Security statement, which they can get from the Social Security Administration electronically. It's the amount they would receive at normal retirement age, which is what the Social Security Administration calls it, or sometimes people call it full retirement age. So it's the amount that's neither reduced for claiming early nor increased for claiming later, for delaying. And so it's always a monthly amount, and that's how you would find that. There are other ways in Income Lab of getting to Social Security estimates. This is a very straightforward way to do it. And now we can see, okay, if they both claim as soon as possible, which is in January, in a month, the amounts that they would get. If they wait until full retirement age, it's going to be the full PIA, right? Okay, so now let's add this. So we're adding $6,000 in future inflation adjusted income. And this is okay, so we added $6,000 here. And that added, you'll notice, more than $6,000, or let's see, I guess we were closer to 8,000. So it didn't add quite a dollar for dollar amount, because what we've now put ourselves in is a retirement hatchet situation. So a situation where the withdrawals for the portfolio have to make up, in this case, 100% of their income early in retirement until they hit Social Security, right? So this is the beginning of the main reason why we really, in doing full holistic retirement income planning, we can't just focus on portfolio withdrawals. One reason is that smile, right? So, okay, we're withdrawing a certain amount early, but we're going to withdraw less later on. And another is this fact that outside cash flows, non-portfolio cash flows, are super important for most people. And in this situation, asking, how much can I withdraw for my whole life? There's no one answer to that, right? We're going to withdraw a lot early on. And then when Social Security comes in, we're going to withdraw less. And then that amount is going to continue to go down through life. So really the question that we focus on in Income Lab is, what can I have? Right. And this is, think of it as a full retirement paycheck, which the makeup of which will change over time. So maybe initially it's all portfolio withdrawals, and then later on we're going to get more and more other types. So let's look at kind of this full plan. So here I've added in the other parts of this household. So we have now a rental income, a single life pension, self-insuring long-term care, and a housing downsize, all within the plan. So let's go over how you would enter each of those. For the housing downsize, I've actually added the assets. So if you're looking to build kind of a full picture of someone's situation, you will typically want to include their assets. That will help LifeHub have a richer, fuller picture of their full financial situation. And so adding the assets in here can be really nice for that, even if they're not buying and selling assets. But if they are buying and selling them, this is the place to put them in. So let's say we own 123 Main Street. And we're gonna plan to sell it in 10 years for $800,000, and we're gonna estimate that at that point, because we get an exclusion on this as our primary residence, and maybe there's some other reasons, our basis is 600. And at that same point, we're going to purchase a condo for $450. I also put the mortgage on 123 Main Street in here. They have $100,000 left on it with a 3.5% interest rate. And they're going to be paying that off in just a couple of years here. It's a normal amortizing loan. This is a really nice feature. Typically, expenses that when they go away won't be replaced with something else. So they're not, groceries, they're not gas, they're not, kind of ongoing insurance. They're kind of a special thing. You'll want to call those other or variable expenses. So a very typical situation is a mortgage that goes away. So we're going to need to make sure to fund that mortgage. But when that expense goes away, it's not that we're going to, let's make up for it by buying more wine or something. It's just, once it's gone, it's gone. So that's why this is an other or variable expense. Typically, if you have specific expense goals that are notable, meaningful in size, and will go away, this is where you're gonna want to put those as other variable expenses. And I did put so a mortgage or a liability is a typical one of those, and you can put that in right in liabilities. If there's other ones, so for example, here the long-term care expense, you'll want to put those under the expenses tab in other variable expenses. So here I put $4,000 a month for I guess that's 5 years. Oh no, 4 years. Toward the end of the plan. So there are a lot of ways you could do this kind of thing. You could move it earlier, you could make it bigger, in order to be even more conservative and kind of see what it would cost to quote unquote self-insure for this long-term care. But other things might be maybe there's a big expense, a wedding you're funding, or grandkids educations, right? Any kind of specific expense goals. That's where you want to put those. Okay, so now we can look at the entire picture here, and we've captured the $2 million portfolio, the mortgage payoff, the housing downsize. We've included Social Security. We've got rental income. Oh, I forgot to show you that one. Self-insuring long-term care, and a $10,000 spending goal. And you can see now they're comfortably meeting their their spending goal. We can see the full picture here, which includes the sale of 123 Main Street. I'm going to click that off so I can see more of this. Okay, we can see early on, we're taking out extra. So again, that's a good reason to not to focus on portfolio withdrawal rate, right? Because here we actually need to withdraw even more in order to handle the the mortgage. And then later in the plan, we're also funding some long-term care. Now, it may turn out we don't need to fund that, right? But we're planning for it in order to be conservative here and saying, well, how would I need to adjust my spending today in order to make sure that I have a reasonable chance of funding that liability in the future. So now we can see kind of this richer set of income sources and why just focusing on portfolio withdrawals is not a great idea. Okay, so there's a few other things we could do with the plan now. We could, for example, explore different funding levels for Social Security. So let's say we want to look at taking Social Security as early as possible. Now, what this should do is change our actual spending rate, and you can see it did. It went down as expected because we have less in Social Security. So Social Security will start next month now, right? And because of that, we're also taking less from our portfolio. And so the income adjustment plan will have changed as well. So this is another crucial thing about Income Lab and the income adjustment plans. So we're not just after kind of an answer to the question of what can I spend, although that's a really important one. And the default way that we approach retirement is by saying, okay, let's build a picture of a household, including their kind of risk profile, right? So how willing are they to adjust income down in the future? And we say, well, how much can we spend given this? But we also want to plan for what would change that spending. So what would cause us to adjust our income? So here, by moving Social Security earlier, it's going to take a 25% drop in our portfolio to trigger an adjustment. But if I go in and now push these later, so now we'll delay to 70 for both these people. And of course, I've made them the same age. If they were different ages, we'd be staggering things, and all of that's handled if they were spousal. Okay, so now in this situation, actually, there's not a huge effect on moving their Social Security later. So it does put the downward adjustment a little closer, 2% closer, 23 instead of 25, and that's to be expected. The reason is we have more portfolio withdrawals, that the blade of the hatchet is larger because we've delayed Social Security, right? So you see a lot more pink here. And that means that there's more sequence of return risk in this plan than in the one where we take Social Security much earlier. So that's the trade-off between Social Security claiming early and late. Now, for a lot of households, you'll also see a large change in the amount they can spend by delaying. For this household, not as much. But that's the key trade-off. And it's a trade-off you see in Income Lab because you have that income adjustment plan, right? Now, for this family, this may or may not be important to them, that small difference in their guardrail, their lower guardrail. If it's a more risk-averse household, it certainly could be an argument for taking Social Security earlier just to push their income adjustment plan out a little bit. Okay, Now let's switch to, I think I already had it in here. So let's switch to a situation where they're delaying retirement. So let's imagine that instead of $10,000, or here, let's go back to the main income plan. Let's say instead of $10,000, they actually want $15,000 in spending. So the current plan isn't going to hit that, right? It's there's going to be bad news for this family. What did I do? Oh, I must not have saved it. Here, we'll just do it here. Okay, so now I'm not quite hitting it. Now I'm fairly close here. So there's some small changes I could make in order to hit my spending goal. But let's imagine it's a bigger gap here. One option is clearly to delay retirement, right? The news might be, well, we can't afford to retire right now. Let's push it out a few years. So what I've done in order to switch this plan to a pre-retirement plan is they were set to currently retired, which really says, okay, well then, I'm already retired. I retired in the past, right? But I can set the actual retirement date. Let's say we're going to retire 3 years from now. And right now, the system will take the earliest retirement date you set and say, okay, that's when I'm going to start building this retirement income plan. So now in this case, I have them set at the same date. So that's one thing to do. Another one is if I'm in pre-retirement, if I want to have that kind of full picture with full tax estimates and for LifeHub to really, display what's real in this family's life, I want to go ahead and put the amounts for their pre-retirement for any salaries or income that'll go away at retirement. I want to make sure that's in here. So otherwise you're going to see some strange things in LifeHub. For example, if you have a savings plan, it's going to look like you have a shortfall because it's not going to know where to take your savings from. So the other thing is I want to make sure that I put my account contributions in. So I've got them both saving $1,500 a month from their paychecks into their workplace retirement plans. Okay, so those are the main things to change if you're doing a pre-retirement plan. So set the retirement date. Make sure you have the pre-retirement income in the plan, and add your account contributions. So now let's okay. So now they're still not quite getting there. Another thing you can do is change the income setting. The income setting is basically saying what's my attitude toward the trade-off between current income, so how much can I spend right now, and the chances I'll have to pull that back in the future. So now if this were a household that is maybe a little bit more willing to accept some variability in their income, then you could push that income setting up. Okay, so they're getting a lot closer here. We're only a few $100s out. There's a lot of different things you can do and test what what changing those goals would do to the income. So for example, if we got rid of the legacy goal, that wasn't a huge legacy goal, but you will see, okay, that did it, right? So you can kind of see, because we're always building a holistic custom plan for a given household, you can see what each portion of the plan is doing to the proposed income. So that $250,000 adjusted for inflation legacy was costing us, a couple $100 a month. And so you can really see the effect of that over time. Okay. There's a few other things I wanted to go over before we go to questions. One was, this plan has a, actually, let's go back to the main income plan. This plan has a pension in it, and it's a single life pension. Okay, and this one I actually have set not adjusted for inflation. So this is just $500 a month that John gets whenever if he's alive. And you can see kind of, it's in gray because it's not editable here. If John dies, this is going to go to zero. If Mary dies, it's unaffected. That's what a single life pension looks like. If you had another kind of a pension, maybe it's full joint life. Right now, I switch it to, it ends at the second spouse's death, and regardless of what happens, it stays at $500. If this were a 50% survivorship, this is where you would edit. I'd set both of these at 250. This is also a place, sometimes, especially with maybe a smaller single life pension like this, you might wonder, okay, when I set it as fully single life, what the software tries to do is say, okay, well, given that this $500 might not be around for the entire life of the plan, because John might pass away before the end, it's trying to adjust for that mortality risk, right? And so this isn't going to have a huge effect on the overall plan because it's only $500 out of almost 15,000, but we're at 14,850, right? Now, you might actually say, well, the expenses are going to go down if John were to die. So rather than adjusting for this fact that 500 could go to zero, so doing sophisticated, mortality adjustments in the background, you could say, well, actually, if John dies, Mary will just spend less and take the full hit, right? Forget about the 500,000. I can do that by switching to kind of pretending this is a joint life pension. And now this will stop doing those mortality adjustments because it thinks there is no adjustment on John's death. And now we can see it probably won't be a huge difference because it's such a small. So this is a very small increase. But this says, okay, fine. If you're willing to take a $500 cut when John dies, this is how much you can spend. So with those pensions, which they're fairly typical to see kind of a single life pension in a household situation, that's how you would compare planning for that mortality risk versus fully accepting the mortality risk. So fully accepting, you'll just set it to last for both lives, and the point then is, okay, if this goes away, it goes away. We stop spending that money. If I set it to be, the way it really behaves, where it goes away when somebody dies, then I'm saying, okay, this is how much we'll spend, and this will give us a chance to just continue our spending at that particular rate. Okay, the last thing that I wanted to go over was looking at some of the tax planning options. So let's go to the tax center. So these folks had, a decent amount of I think it was about $1 million in workplace funds. So the question, and they're fairly young. So the question is, would it make sense for them to do any Roth conversions in this plan early on? So we're just subjecting the that base plan that includes everything, right? And that's really important, because any change, to Social Security claiming or to timing of things will affect the tax calculations. And we see in the tax setter right away that it's saying bracket management to the 24% federal bracket comes out from a tax perspective to have the most attractive profile. So that one's marked with the star here, and you can see, it's got the highest net income, the lowest total taxes, the lowest average tax rate, and so on. Now, in your work process, when you're doing tax planning, it's important to remember this table isn't determinative of what someone's going to do. So choosing the one that has the lowest estimated future taxes is not necessary. It could be that a particular client profile doesn't lend itself to huge Roth conversions. Maybe you want to limit them. Maybe you're balancing the Roth conversion profile with the fact that, for example, it's going to take some time for there to be a break even. So for these folks, the estimated break even is in 19 years, right? Now that's well within a lot of people's life expectancy, but it could be something that is, not as palatable to people. And they say, well, let's hedge our bets a little bit and do some smaller Roth conversions. So this is there's a lot of art and science to tax planning. So don't feel that just because the 24% bracket comes out with the lowest estimated taxes that's what you have to do. In the estimates here, these are very small differences, right? Even the 22% bracket, we're talking about basis points in difference over their lifetime. So if that's more palatable to a client, please kind of go for it. So for example, if we decided that, well, the 22% bracket is what we want to focus on here, we can then dive into what that would mean in terms of our actual actions, right? So we can see for each year, how much we would be doing in Roth conversions. This still involves, almost a $200,000 Roth conversion. Another great place to kind of look into how to implement a particular plan is in LifeHub. Oh, and I actually didn't edit that. So let's go ahead and I'll show you another place to change. We're going to go ahead and do the 22% bracket. So it's in the advanced settings in taxes. There's a lot of, fine tuning you can do here. You can, we're automatically applying tax cuts and job back sunsetting, but you could turn that off to see what it would look like if that didn't sunset. You can set dollar-based caps on Roth conversions. You can specify which years Roth conversions are allowed. I'm not going to do any of that here. Okay, so now I can see for my Roth conversions. Now, because this is a fairly simple plan, we're doing equal conversions on both of them. But if, let's say, for example, John, we're retiring a few years from now, and so he didn't have access to his 403B, you would see all of them coming from Mary's and so on. So you'd see some interesting differences here. But this is a great place to find kind of the the implementation details for how to do this approach. And over time, we're going to see that we're doing a bunch of Roth conversions. Those are going to go down basically because they're going to move all their money from the 403B here, and then eventually the brokerage account will start funding a lot of their withdrawals. Okay, so that's we've kind of gone over now this baseline how to include all of these kind of typical elements in a plan. We've looked at how to look at delaying retirement. So Income Lab can be really useful if you're a couple years out from retirement. And we've looked at Roth conversions and bracket management, how to find those sources and destinations for conversions. We didn't spend a lot of time on LifeHub here, but that can be a really useful way to walk clients through what the actual plan looks like, and see when different things are happening. So for example, up here I see, okay, this is when John's pension is beginning in 2025, and that's also when we pay off our mortgage. We're both starting Social Security in 2031. We're purchasing a condo and selling the main house in 2032, and then RMDs are starting in 2033, right? So all of that is visible in the timeline here, and as we go through the plan, we can kind of show, for example, that the taxes early on would be quite large, but that once we're done with our Roth conversions, we get taxes really under control. Okay, so with that, I think we've probably got a lot of questions, and you can take those along with and Derek can jump in, since I'm sure he's done a lot more real planning than I do. I just play a planner on TV.
I would just say real quick before you jump to the questions, but want to get to those. I do, on that last piece, the LifeHub, for me, that can be a really great place to just actually sit down and review the assumptions of the plan, even if it's a client you worked with before and it's more of an update meeting. Walk through, make sure nothing's changed, walking through account balances that maybe aren't automatically synced. If it's something that the client can tell you, wait, that account's actually now about $100,000, whatever it might be. I do find that this like fully blown out view where you can see all the different pieces can be really useful just for like a check-in meeting, and as kind of the primary discussion point to walk through.
Yeah, and the other thing is I used the normal kind of stepper to change data as we were going along here, but you can actually do everything I just did in LifeHub. So for example, if you wanted to change, Social Security claiming for, maybe one but not the other, I just hit save, recalculate values, and now everything in LifeHub will reflect that change. Everything that I did can be done from within LifeHub. So if you're the kind of person who prefers this more visual data entry, that's a good option for you.
Perfect. Thanks, guys. We do have quite the questions here, so I will hop right into it. First question is, what is the rule of thumb for portfolio allocation? Should it be set as the current allocation or the anticipated allocation during retirement? Any thoughts on there?
I would say it's definitely your target allocation. So now sometimes, especially if it's maybe it's a prospect situation, you might want to do just two scenarios, one with their current allocation and one with the target allocation you think is appropriate for them. And then you can compare, hey, this one provides you more income, or it provides you more appropriate guardrails and a better risk profile, right? So you can do that side by side planning. But for the plan you're actually going to follow, make sure it's the target allocation. And there's a bunch of ways that you can do that. I don't know if I'm logged in as, no, I'm not. But as a firm admin, you can actually build model portfolios, as many as you want. So maybe you have 10 portfolios that you use in your practice, and then you can just pull those in to a plan. And then if you change the allocation kind of at the model portfolio level, that'll trickle into all of the plans that have that model. So that's a really nice way to use it for target allocations. Derek, do you have thoughts there?
I do think it can vary a little bit depending on, if the question was getting at like how, say you're planning for an accumulator who's still away from retirement. I think for me, the retirement period is often so much what I'm looking at. So even if somebody's 55, they're not going to retire till 65. Maybe they have a little bit higher stock allocation today than they would have in retirement. In that scenario, I'd probably still lean with the retirement portfolio is what I would model in that case, just because that's going to be the portfolio that's in effect for the longest period of time throughout the plan.
Yeah, and that is a feature that we're working on here. I know we've had some requests for kind of maybe it's a pre-retirement, post-retirement portfolio. That's very much on the roadmap for Income Lab.
Perfect. Next question, guys, is why doesn't Social Security amount increase due to COLAs?
Yeah, so actually it does. There's throughout Income Lab, there's an interplay between real or today's dollar views and nominal or future dollar views. Now in LifeHub, everything is nominal. We may at some point offer you the option to toggle between them, but the reason is LifeHub is kind of meant as a client to be used with clients, of course, for yourselves as advisors as well. But people tend to understand things better in nominal, even though we actually don't know what spending $100,000 in 20 years means, but it's at least that those are the dollars in our pocket, right? And so as you click through here, for example, you see this Social Security amount going up every year, and that is the COLA. But if you're looking in the income plan, in cash flows, now this is set at real, meaning today's dollars. So don't show me inflation adjustments is basically what this is saying. And so here the Social Security amounts are staying the same. So 1750, in today's dollars. But if I change it to nominal, they'll go up. And then for an implemented plan, we will actually apply the actual Social Security COLA in January to your implemented plan. So it'll automatically adjust in the right way.
Perfect. Next question here is, how would you model a mortgage that is paid off when the home sells?
Yeah, so that is we have some further small features to kind of continue to connect pieces of the plan so that you don't have to kind of enter dates in multiple places. So in that situation, I think you're going to have to do some multiple manual entry still. So set the mortgage to be paid off at that point. I'm going to have to think through it a little bit. Yeah, you probably would have to adjust the mortgage amount and then put a big lump sum payment in your expenses. Yeah. And then, but like I said, that's sort of an unsatisfying way to do things. So we do have, we've made some progress already with those automatic liabilities. So tying that to the asset sale is something that we're planning on doing.
And here's a follow-up question on the kind of the mortgage entry as well. I thought the mortgage would show up under other variables since you checked the box in the mortgage entry section. So I think just maybe clarifying when you do kind of check use as other variable on the mortgage entry where that shows up and how the user can see that.
Yeah, so the easiest way to see it is in LifeHub. I mean, you'll see it in the expense graph as well, but you'll see here other variable expenses, the home mortgage payment, and you can see it being paid off in a couple of years. That'll be tied to the liability, which also is being slowly paid off.
Perfect. Okay, and then this next one kind of has a few parts to it, so I'll kind of walk us through the scenario here. So the desired income figure is essentially my core ongoing expenses plus income tax, yet income taxes can be lumpy or uneven. How do we account for that? And what happens if income taxes are $5,000 annually, now they're $7,500 annually later, then my desired income will be misleading. And am I able to see future taxes in Income Lab for reality check purposes? If the taxes are uneven, should the advisor enter taxes under variable expenses, for example?
Yeah, so typically the full workflow, if you're really dialing in a plan, is first to run, to build the profile like we did here. You could even do it by kind of layering on the onion like we did, put the portfolio in, add the other income flows, and so on. And that will give you a feel for, okay, what is a reasonable income target for these folks? You may be, kind of lucky, like in this case where, hey, the $10,000, that was actually fully achievable within a variety of settings. But then if you're doing anything where taxes could be lumpy, and that's, like you said, that's fairly typical, though not always, then you would switch to, so maybe I'm in this income plan, and I forgot I changed this one. So and now I want to say, well, okay, I know that I have this this surplus, at least in certain years, but we're really not going to spend more than $10,000. So then what you'll do is you'll switch to a solve for setting. So instead of asking, what can I have, which is a really natural, normal first question, it's okay, well, we think you can have $10,000. So now let's solve for it. And what you're asking the software to do now is, instead of solving for a, kind of a gross income level and then netting it out for taxes every year, it's saying, all right, start me at 10,000, now gross me up to handle the taxes in any given year. And so now what you'll see in the cash flows is you'll see a portfolio withdrawals profile that is grossing up, in the years where it needs more to handle the taxes. And you'll also see that really nicely in LifeHub. In particular, now this is still in beta, but should be coming out of beta soon. You'll see, kind of this match, and it's matched perfectly. This is one reason it's in beta. When there's no surplus, we shouldn't show you anything there. But you'll see, okay, we've got exactly the right amount of portfolio withdrawals to handle our expenses, handle our taxes, handle our other variable expenses, handle our Roth conversions, and so on. So the kind of the full workflow, especially if there's a Roth conversion strategy, is to eventually go to solving for income.
Next question here is, this user's noticed a big difference between first month less and the following year income when someone, looks like they've noticed a big difference when they have the person retiring in the first month versus when they're retiring mid-year. And I think they're kind of talking about the net in those situations. Any kind of insights on that?
Yeah, because in Income Lab, we're really trying to give you good estimates for taxes. If you're retiring, this does often come up when you're retiring mid-year, but frankly, it can even happen if you're retiring in January. If there are any kind of lumpy income sources that are happening in that year, we do have to reflect the taxes that are related to that thing. So maybe you're doing that housing downsize in the first year of retirement, or maybe you're selling a business, that will increase the taxes due in that year. Now, if that happens before retirement and you have a mid-year retirement, we do adjust for that. So let's say you sold a business in March and you're retiring in September. The taxes you'll see in the in kind of this net number, they won't reflect all of that, the taxes due on the business sale. They will only reflect the taxes that are relevant to the retirement period. But even so, that actually will be different than if that business hadn't been sold in that year, because that will have pushed us probably into higher tax brackets and so on. So in a way, there is no, I understand what people want probably is a gross to net that reflects sort of the ongoing expected tax burden during retirement. But in order to do that, we would sort of have to ignore a really relevant thing to your tax situation. So you won't typically see such a big difference if there aren't those lumpy expenses. But if you're retiring mid-year and let's say you had high salaries and then they went away, there's almost no way to avoid seeing that a slight difference between year one and year two. One thing you can do is push retirement to January, and that will at least ignore kind of pre-retirement tax situations like high wages, FICA tax, things like that. But there really is not a perfect solution that will both accurately show you taxes and give you kind of a better long-term feel that ignores pre-retirement.
And then next question here, in the income setting example, when you moved it to more aggressive, how would you explain to the client the specific trade-off? Aggressive may be ambiguous for some clients. So maybe if you can offer just some pointers there on kind of explaining that.
Yeah, and actually we're working on some really cool features to help you tell that story more. So we're expecting those next year, hopefully Q1. But for now, what I would say is whenever you move income settings to the more aggressive stance, what you're saying is, hey, I would rather spend more now and accept the possibility that I'll have to pull that back later. Now, I'm pulling it back from a higher level, right? So a certain amount of pullback would just put me back where I would be if I were being more conservative from the beginning, right? So there are people who will just say, well, look, that's sort of gravy. I'll take that and be willing to pull back. There are other people whose lifestyle and financial resources are such that they can afford to be more conservative. So actually, that was kind of the situation we were in with these folks. Is they wanted 10,000. Maybe that's really all they needed, and maybe their full plan was giving them 14,000 or something, or I forget what the net was, 12 or 13. One thing you could do then is just pull the income setting back and say, well, look, you don't have to be so aggressive, and that's going to have a payoff for you in the sense that there's a lower chance that I'll call you, counseling a reduction in income. I don't know, Derek, do you have ways that you kind of talk about that trade-off?
Yeah, so for me, I actually often find myself in a situation where many of my clients don't even want to spend what they could spend. So a lot of times I am pulling that back to like a conservative setting, just because whether, if their target is really to only spend 10,000 and it's saying they can spend 14,000 even at a conservative setting, they don't really need that. But for me, I think what you said at first is exactly right. It's all about, are you willing, what do you prefer? Do you prefer to spend more now with the chance that you would have to reduce that spending in the future? Or do you really want to go the other direction? And estate planning is relevant there as well. You're going to preserve more estate, pass on more legacy, the more conservative of an income setting you use. And so really, how important are those competing goals for a given client?
Yeah, and if you want to see what those settings mean, like I said, we're actually building some cool visualizations to see how the guardrails move as you move that slider. But it is, to the extent that this helps any given client, if you go to the power planning, you'll see, okay, so the conservative setting is targeting an income level that has, an estimated 0 chance I ever call you with a reduction. Obviously, you could still get a reduction, right? This is within the model that you're using, whether it's your capital market assumptions or historical, right? If things turn out much worse than our assumptions, then you could still get a reduction, but it's targeting a 0% chance. Moderate is targeting a 20% chance, still relatively low. That's why it's called moderate. And aggressive is targeting a 40% chance. So almost a coin flip. You're saying, well, give me an income level that there's almost a coin flip that you call me and tell me to reduce, right? And so these are different like personality types. It also, there's an effect on, depending on how this person is sourcing their income, right? If they've got a lot of pensions, a lot of Social Security compared to their overall income, being more aggressive, that could still have guardrails that are fairly wide, right? Because if you have a lot of non-portfolio income, it's going to take a bigger move in your portfolio to force you to make a change in your spending. Whereas if you're funding most of your spending from a portfolio, being more aggressive also probably means that downward adjustment guardrail is a little closer. And for some people, it might be too close for comfort.
Perfect. I know we are up on our time. We do still have a few more questions in here. If you guys don't have a few hard cutoff, we can work through a few of these for our users. We will send the recording afterwards. So if you have to hop off and we're getting to your question after, you can definitely catch the recording to get the question. And then if we didn't have a chance to answer your question, you can also drop your question in the survey after, and then one of our team members can also reach out. But Justin, next one here, as I'm just looking it out to see what other people have voted up on. Oh, in the if the legacy amount is leaving the condo, is being left in the condo or the house, should the user still put an amount in the legacy field?
If that's enough, then no, you can go ahead and set a 0 in the, what that legacy field is really, how much of my portfolio do I want to leave behind? So if there are other assets that can cover their legacy goals, go ahead and put it at 0. The software is always trying to balance the goals, legacy goal being one, but know that if you're actually following an income lab plan, and you'll see that in the plan test section as well, there's no point at which the software, assumes that you're dead. So you always have some life expectancy. Even 30 years from now, if you're still alive, it'll still assume you have some life expectancy. So it's always trying to keep you, north of 0. It's never saying, well, good, next month, let's spend all our money, right? So setting a 0 legacy goal is perfectly fine. You'll still see in LifeHub, they're not going to 0 in those situations, because at the end of the plan, they're not assumed to know that they're passing away tomorrow.
And next one here is does Income Lab account for Medicare premiums, and is Social Security adjusted for those premiums?
It does. So you'll see Medicare premiums split out. So the IRMA portion, so the income related, let me think, something annual amount. You'll see that inside taxes. So it may be that there is no, oh yeah, there's some Medicare IRMA here. You can see some years it's on, some years it's off, right? Depending on, there's a 2-year staggering of your MAGI calculation that goes into this. If you want to include the baseline Medicare premiums in the plan explicitly, just go into the advanced settings and say include base premiums as an expense item. I wouldn't say that there is a particular reason to go between baseline and other variable. It's really up to you in that case on how to include them. This is also, you can put in what the Part B base is, Part D base for that particular client. We do kind of an average as a default, and that tends to work for a lot of people. But if they don't have Part D or they didn't have Part B, you can turn those off as well. Or if maybe they're not claiming at 65, maybe they're going to continue working, you can turn that off and set the begin date for Medicare.
This next one's interesting. First time we've gotten this question. How do you show Roth conversions of fixed index annuities over several years prior to turning on the GLWB income? I'm not specifically sure.
Yeah,
GLWB.
that question. I'd have to think it through. Yeah, maybe we can take that person's name down and get back to them on that one.
Yeah. Got the name. Rodney, we'll look into that one for you. And then we can take one more. Is the total on the income sourcing net of tax?
So income sourcing, depending, I guess, where you look. So if you're in the income plan and looking at the cash flows, then the total is gross of tax. So, here's income sourcing. and the table will be, there's kind of a subtlety here. We call it gross spending to kind of say, okay, this is the amount that's going to fund our spending, but it's gross of tax. Okay. There are other concepts, in particular, if you're in the tax tab, here, what you will see is a total gross income. And the reason that's a slightly different term is for the IRS, certain things matter to your tax bill, right? Like things like maybe it's reinvested dividends or, kind of things that count as IRS income, but aren't. They're just, sort of passive things that you're not actually using to fund your spending. So that's why there's a difference there. And you'll sometimes see these numbers be slightly different. On the tax tab, you're looking at total gross income from an IRS standpoint. For income sourcing, you're kind of saying, hey, okay, but what's the stuff I'm really using to fund my lifestyle, and what's the gross amount here? We've have had some requests to kind of add in a tax amount here to kind of bring those tables together a little bit more. So we'll probably do that at some point.
Perfect. And our last one here, Derek, I think you might actually, you previously kind of talked about this on another webinar, but around implemented plans. So if the proposed income is based on the idea that the plan will be implemented on a monthly basis, what if as an advisor, I want to only review and make changes on an annual basis? Does that mean the proposed income with the adjustment trade-off is not as reliable? Derek, I know you kind of shared that with your thoughts.
Yeah, I personally wouldn't be hesitant at all to, even if you did just want to do an annual check-in, right? The plan is going to be, if it's implemented, it's going to be updated monthly. It's going to tell you if a guardrail was hit. I mean, at that point in time, you could decide, do you want to reach out earlier? Sometimes we hit a guardrail and the market comes back and, it turns out that an adjustment wasn't actually needed. So I do think if you were waiting just to check in annually, you're going to avoid some of those false positives. Sometimes it might drift further into adjustment territory. But I think that's definitely a feasible thing that you could do. Just realize that I guess some of the, the notifications in terms of like triggering now the automation in terms of knowing that now is the time to make an adjustment. You're just gonna have to go into the client's plan, look and see where they're at. Are they beyond where the guardrail would have called for an adjustment? And then you can make that adjustment at that time. So yeah, I really don't see any issue with that. Just know that the implementation on the back end just means that it's still getting updated monthly, no matter what your actual meeting frequency is with a client.
Yeah, I mean, we do it monthly so that at least monthly things are updated. Your particular cadence, your surge time of the year, anything like that, any business processes you have in place. Like some people might be doing meetings in May, some people might be in September. So that's one reason we do monthly automatic updates. The other thing I just wanted to point out is, through a combination of plan factors, you wouldn't expect there to be adjustments every single month. In fact, in this plan, it only even sees an upward adjustment every 2 years on average, right? Of course, there could be situations where maybe there's out of control inflation, and so you have a lot more inflation adjustments, or markets are really tanking, right? And so you might see multiple in a row. But typically you're not. I wouldn't have a lot of anxiety that if I'm not talking to my client every month about this, I'm missing adjustments. You won't be.
Perfect.
Yeah, and to give a good practical example, I mean, look back to what happened with COVID. If you didn't make an adjustment, and maybe the plan would have been calling for an adjustment at the front end of the decline from COVID, chances are with the recovery, by the time you didn't take long for that to go down and come back up, you wouldn't actually need to make an adjustment. Or if you happen to make the adjustment, and things recovered, and then you could get out to your annual meeting and make that adjustment later. But I don't think anything here is precise enough in terms of that's not what we're going for. We're just going for the general strategy of, is it time to cut things back based on where the market's at overall.
Yeah, that's right. So like these guardrails, they're in a typical plan like this one, there's an asymmetry, right? Which is reflecting people's preferences, that they would just like the downside to be farther away than the upside. I mean, that's a very natural, human preference. But yeah, maybe this portfolio in February, March of 2020, maybe it would have gone down more than 24%, right? And it would have triggered a guardrail in that situation. then, the next month it might be right back. So yeah, I don't think it's when you get the notification on your dashboard, well, I need to make sure I call everyone today.
Well, thanks guys. And thanks so much for all of our users who participated, for your questions, for those who hung on after the time here. We really appreciate just all the engagement and just all the feedback as well on the software. Please keep them coming. And Derek and Justin, appreciate all the work you guys put into the webinars as well. I'm excited to keep those going for our users next year as well.
Yeah, thank you, everybody. Thanks, Matt.
Thanks, everyone.
Have a wonderful day, everyone.
Take care.